The Finance Ministry tweaked the norms for capital restructuring by central public sector enterprises and introduced flexibilities to enhance the value creation strategy. Let me take it across to my colleague Sumit, who's joining us with more details on this one.
Well, Finance Ministry has revised capital restructuring guidelines for CPSEs, which are central public sector enterprises. Let's begin with dividend policy change. Well, now CPSEs will have to give either 30% of their PAT or 4% of the net worth, whichever is higher, as dividend to the government. This rule will apply from the current financial year. Reason is that CPSEs are having a lot of money in their hand and their market cap has jumped over the last few years. If we give an example, in the last 3 years alone, market caps have jumped over 500%. So government will get some handsome dividend from CPSEs as part of this. There are other guidelines also. Let's begin with another guideline, which is on dividend and share management. Guidelines say CPSEs should issue bonus shares if their reserves and surplus exceed 20 times their paid up equity share capital, and for listed CPSEs with a market price consistently more than 150 times face value of over 6 months, share splitting may be considered as well. Let's go to operational flexibility and investor participation. The guidelines on them. Revised guidelines propose that CPSEs consider quarterly interim dividend or at least biannual payments. Now, listed CPSEs must pay at least 90% of their projected annual dividend in interim installments. So all these guidelines have been issued yesterday by Finance Ministry.
Well, thank you so much for joining in and giving us all those details.
If you like this video, then like, share and subscribe to ET Now.